This podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.
Well, gentlemen, welcome. Another Friday is here.
Welcome.
Cheers.
Salud.
Cheers to all of you. Having a
Happy
rosé.
hour.
Summer rosé.
Summer
nice.
rosé. I'm doing local honey and tea, so not
Love
quite
it.
there with you.
At least lie about like a shot of alcohol of some sort.
Nah.
No, you can't do
4
it.
o'clock in the afternoon.
Too
I got
much
work.
integrity for you. 4 o'clock on a Friday.
He's a very integrous person. Well, and thank you. Welcome, Dave Nadig. I'm sure most people who tune in here know Dave, and thank you for co-hosting us and joining us today. And while we interrogate Mr. Hougan on all the various things he's been up to, I will remind everybody that this is for entertainment purposes and that you probably shouldn't be getting investment advice from four hooligans on a Friday afternoon on a YouTube channel. So with that said, let's dive in. So we
Sounds
can,
legit.
yeah, we can talk about whatever we want. Matt,
I love
welcome.
Thank you for having me. It's a joy to be here. I've been looking forward to this.
Yeah, us too. Tell us a little bit about you, your journey. You can go back as far as you want. Just let everybody know where you're from, how you got where you are. Tell us everything.
Tell you everything. Wow. My journey into the investment space starts with Mr. Dave Nadig, believe it or not. I was working as a minor league baseball mascot in Maine and read an article about a business Dave started. Thought it was cool.
You have to tell us the name, Matt. You can't just leave that hanging out there.
I'm gonna. Yeah, I've got it. I know. I got to know the team.
Oh, I thought you meant of your business. No,
No. That you don't just get to drop minor league mascot and not finish the story. You schmuck.
That's true. I was Slugger the Sea Dog, which is a 8-foot seal for the AA affiliate of the Red Sox. Now they were the Marlins at the time in Portland, Maine. My job consisted of dressing in an 8-foot seal costume, mostly opening car dealerships, but I did get to play in a celebrity basketball tournament. And I will tell you that trying to shoot a basketball with flippers the size of my chest is quite an experience. So that was my resume. Dave was running the world's first transparent mutual fund, and he looked at that resume and said, "Yes, that is the man I want as my new analyst."
To be clear, this was 3 years ago, right?
Exactly.
What a journey.
That was my start. Then I bounced around a little bit. I spent a long time in the ETF industry. So my big claim to fame at first was in the ETF industry. Worked with Dave on a company called ETF.com, built the first ETF rating system in the world, the largest ETF conference, largest ETF media space. We eventually sold that business.
ETF ego. Yeah.
ETF ego. Dave, did I mention I won the Lifetime Achievement Award in ETFs this year?
No, that was like 4 minutes. Congratulations.
One thing you might know about that award actually is that Dave hasn't won it. That's one of the characteristics of that award.
Due to a decade of ineligibility, I have to say.
I'm just joking. Dave, most of my career has been letting Dave do work and trying to take credit for it. After my ETF journey, after I sold that business and did an earn out with the conference company, we sold our conference unit separately. That was our biggest unit. I did 2 years for a FTSE 100 company running conferences. I made a switch into the next big multi-trillion-dollar market that's growing quickly, that no one understood, that people thought was toxic, that people described as weapons of mass destruction or rat poison squared, which of course is crypto. And so now I'm the CIO of Bitwise Asset Management, which manages somewhere north of $1 billion in crypto assets for mostly financial advisors, some hedge funds, some institutions, some retail investors. And we're best known for creating the world's first crypto index fund. So we're kind of like the world's most conservative, boring crypto asset manager, if you can concatenate those phrases into one. That's us.
I love it.
Yeah, the
So
the lower bound of boring is still very exciting, right?
Yes.
Although
is
I will
definitely
say,
true.
Matt, leave it to you to find the way to make crypto boring.
Hey,
Yeah.
hey, we all have our skill, Dave. We
Yeah,
all
like
have our
no, but like interestingly, like it kind of was needed. Like I mean, you guys have been pretty successful at being the boring guys in the crypto space.
Yeah, well, you're taking enough risk on an asset class that's new, nascent, emerging into the regulatory space, has a lot of security risk. It's not clear to me why you would layer on active risk or other trading risks on top of that, particularly for a beta that, even though it's down 50% from its highs, is up 250% over the last year and up 3,000+% over the last 3 years. So I do think it makes sense as a strategy. We've been doing well, just raised our Series B. We're about 40 people and growing. And we think financial advisors are the next major market in the crypto space. And we're surprised that there's basically no one else focused on that market.
Matt, before we get into the crypto and the use cases and all the things that are happening in that space, I actually want to go back to something that you said when you decided to move forward to the most toxic, least loved, et cetera, market. There's some experience, I think, that you bring to the table, maybe personality traits that have led you to like be in there one after the other. So you had, was the ETF space considered the same thing back in the day, Dave, Matt? Like, was it toxic, persona non grata, the end of capitalism and the like?
That 100% true. Yeah. Financial Times called it weapons of mass destruction. They talked about liquidity doom loops. Almost everyone's forgotten, but the US Congress pulled ETF executives in front of it and had a whole interrogative session about whether ETFs were destroying American entrepreneurialism, which is a pretty big claim for a product that really just lets people get exposure to the market for a few basis points less than index mutual funds. But people did hate them.
Spoiler, it didn't destroy American capitalism.
It didn't. Not yet. They're still making those claims.
There's still time. There's still time.
There's still time.
It could happen.
It is true that no one understood them. They called them EFTs. If you talk to someone about the creation redemption mechanisms, their eyes rolled back in their heads. It was all jargon, and people were very skeptical, and for good reason. Another analogy that's similar between ETFs and crypto is that in the early days, ETFs were kind of terrible. The spreads were huge. They weren't liquid. They really weren't the lowest cost way to get exposure over the full term of an investment. But they had one or two really sort of unassailable advantages, right? They had unassailable advantages on intraday liquidity, on taxation, on fidelity to what they were gaining exposure to. And those were enough to eventually overcome the limitations. Same thing's true on crypto. If you look at Bitcoin, it's a pretty janky currency. It's volatile. You can't spend it anywhere. Retailers don't accept it. But there are a few things in crypto that are sort of undeniably true about the efficiency of the technology and the new mindscapes that it opens up. And I think, one question people ask me is, why do some people like me, who look like me, end up in the crypto industry and an equal number end up hating it? And I think it comes down to that, whether you approach it as a currency, in which case it looks highly unlikely to succeed, or if you approach it as this technological advance, in which case it seems highly unlikely for it to fail. And I think that sort of fork in the woods explains a lot of the extremism in crypto. And
is that the difference when you're thinking about moving on to the next business, right? When I think about, okay, you went from ETFs to crypto, some people might look at that and say, well, you could have gone to, I don't know, marijuana or psychedelics or who was the guest that we had on Monday, Mike? Uranium, right? These are just as volatile, just as crazy, but somehow crypto seems to be seen as that plus something very different. What made you not go into like the theme-based stuff and be as toxic as you can be and rather choose this other space?
Yeah,
what was the case?
It's a great question. I think there are two things. One is that I really love efficiency. It's just not like a dorky thing to say, but one of the things I loved about ETFs is that they were just efficient and true and right. And that aligns with crypto. It's not the same with cannabis or other thematics. The other thing And look, I'm not a crypto hyperbolist, right? Crypto tends to be the land of hyperbole. I think the answer is in the messy middle. But I will say, in terms of the market that it's addressing, not the market it will capture, but the market it's addressing, it's by far the largest addressable market I've ever seen a new technology attack. It's attacking finance and money. Like, if you want to abstract back to what crypto is at the core, it's a way to move money and property rights over the internet. It's the biggest market the internet's ever gone after. And so, one thing I learned from the ETF industry is it's great to be in a career with a strong beta to a very large size. You make all sorts of dumb mistakes and still turn out okay. Crypto is going after a very large market. Now, we can discuss, will it get there? What parts of the market can it really capture? But unlike, marijuana or psychedelics, it's really big. It's really big. And there are very few other industries, at least in the finance space, maybe arguably AI, but there are very few that are going after a market that's nearly as big as what crypto and blockchain are going after.
So what do you, so knowing you forever, right? You love solving problems. Like, I mean, that's sort of what I associate with you. When I call you at 2:00 in the morning on a Friday, it's because I have a problem and you're really good at that stuff. So, what are the problems that you saw in crypto that you were trying to solve versus, like, Rod, you're talking about things like cannabis. A lot of those problems are regulatory, cultural, as much as anything. What are the problems you're trying to solve in crypto that you think are really interesting and that you thought were interesting back then? Because I think that a lot's changed just in the last couple of years.
A lot has changed. In terms of what I personally was trying to solve?
Yeah, like what was getting you out of bed?
Two. There are really only two. One was no one understood it. It occupies this giant mind space in society. 95% of people talk about it and they have hard and concrete opinions about it. But if you actually tried to get them to explain what a blockchain is and what space it opens up, zero people, not zero, very few people could actually explain that. And I thought I could help in that. One of the things, Dave, one of the things I did do in the ETF space was give an ETF 101 presentation about 15,000 times. And I think anchoring people on first principles of what crypto really is, what space it's attacking, and what it's not, I thought I could add value there. And then the other piece is sort of the why Bitwise piece. The biggest risk in crypto is behavioral risk with investors, chasing high returns, dumping at the wrong time. Investors have never had access to a liquid, intraday priced investment that's as early as crypto. So they're not used to this volatility. And I thought Bitwise's product solution of an S&P 500 of crypto was the answer to that. So educating people about what it is and then getting a product that helps them not, run into the shoals was what drew me to the space.
Yeah, it seems like a pretty good thesis, right? From the get-go, in an environment where the information that you might be garnering is relatively low in the vast potentialities, right? As you said, the addressable market is huge. The number of coins is huge. What the coins may do, from Bitcoin all the way right down the chain. So I'm taking that mindset of let's let the market sort it out and use sort of traditional finance methodologies is, to me, probably one of the most sound ways, or certainly a first way that you would probably tackle that problem. Is that the way you saw it as well?
I completely agree. I think that's exactly right. And a market cap weighted index that's unconstrained and uncapped does that really nicely. It also means that investors for whom this is often a 1% allocation or a 2% allocation don't have to panic every time Elon Musk tweets something. The index reacts to that. It adjusts to that. And the other thing about crypto, which is maybe people don't think about enough, is network effects are central to the value of crypto assets. And so market cap weighting, I think, is closer to an optimal strategy in crypto, even excluding costs, than it is in equities, where it's an average strategy excluding cost and only beneficial after costs are added in. In crypto, because it's all a network effects business, because size really matters, I've seen lots of active managers run afoul of getting obsessed with technology. This blockchain is slightly more efficient than that. Doesn't matter. This one, is in a regulated space and has liquidity up the wazoo. So I think that's the added benefit of a market cap weighted strategy. is it captures that network effect.
Right. The
Captures
age old VHS versus beta, or the fact that we still use a QWERTY keyboard today, right? The most inefficient keyboard that you could have. It's not efficient. It's not the best keyboard. It's 100% dominates all keyboards.
Right.
Well, because the network adoption was, hey, we're going to learn this keyboard because we have typewriters that get caught up together. I don't know if people remember what a typewriter is, but you had to slow people down in the way they typed. And that's why that is the dominant force. It is not the best keyboard. So just like you're saying,
That's amazing.
if you get fundamentally based in, oh, this is Cardano's better than Ethereum, whatever. But if nobody cares, then nobody cares. And market cap is the way to express. Go ahead, Dave.
Well, so let me pull on a thread here. Okay?
Yeah.
I agree with you, Mike. Right? Yes, I get the logical chain. This is also one of the biggest problems I have with the current DeFi crypto industry, which is everybody knows this, right? Everybody understands that all that matters is how much you get in circulation and how much you get it being used and mined.
Mm-hmm.
And so consequently, we've ended up with this sort of massive degeneracy in what are otherwise really interesting technologies, because everybody realized we got to get the coins out. We got to get the coins out. So you end up with the whole liquidity pool insanity that's taken over crypto for the last 3 to 6 months, really, because all that matters is getting the coins out. And so you end up with things like what happened with Matic, right? Where you end up with poorly designed products, poorly designed liquidity pools that have fatal flaws, but you're rushing to get out there because you know the network effect is all that matters. How do you balance that out? Because it doesn't seem out of the question to me, Matt, that like the thing that's going to boot whatever the 10th thing is in your top 10 out, when it shows up, it could show up simply because they were better marketers at getting people to use it, but it could be toxic technology.
Yeah. Oh, it's so true, Dave. First of all, I completely agree with you. And second, the index tries to screen those.
Okay.
The index, our index methodology tries to screen that out. And I think it does a pretty good job, but it's not going to be perfect. So what are the screens we look at? We have seasoning rules. It's not like an asset that emerges today can enter. It has to be on the market for a certain period of time. We have liquidity in terms of percentage of market cap rules. We have regulatory screens related to security status. On the DeFi fund, we have an advisory council of 5 of the leading VCs in the DeFi space who opine on new projects, investigate if they have real developers behind them. We look to see if there's been a technology audit of the new asset. And all of those screens are binary. If they fail, they're not in. So like, even if you look at our Bitwise 10, which is, the largest crypto index fund in the world, holds the 10 largest assets. If you go to CoinMarketCap, our 10th asset is number 24. So there are a lot of these assets that you screen out because of those risks, but it's not perfect. It's not perfect at all. It's impossible to be perfect. And there's going to be risk and there's going to be blowups. We saw one yesterday. Thorchain got hacked, which is like, I don't know, it's top 50 assets, not in our funds. That's going to happen. It's interesting that we've kind of solved how to jumpstart network effects. That's a big sort of interesting sort of business breakthrough. But it attends with all these risks. We try
the liquidity pool model.
Yeah.
Well, why don't we discuss the liquidity pool model, Dave? Why don't you give everybody here an idea of what the issues have been and why it's been useful in the space?
You want me to go first, and then Matt can laugh at how wrong I am? That's
Bring
probably
it.
the way to go.
I love it.
Give Matt a shot at the.
You brought it up,
if you
but
want
maybe
a more wrong
Matt is
opinion,
the
I
guy.
can
No,
go
so if I'm trying to start, excellent Dave coin, right, and all I care about is getting Dave coin out in circulation. Well, what I do is I set up a liquidity pool where people can stake in something I want to trade Dave coin against. Right. And in order to do that, you have to have some reward, and you pay those rewards out in more Dave coin, which nobody wants to really hold. So they trade it back for something they do want to hold, like Ethereum or cash or a stable coin or a Bitcoin or whatever. But those coins don't go away in that process. So the coins start generating circulation, but their value is really only associated with how much they're willing to turn the knob on how much extra Dave coin you're going to get. And this is where, our friend Corey Hofstein sort of went down this rabbit hole on Matic, right? Where, the 3-tiered, I don't remember, iron something or other. And, there was a multiple coin system with a governance coin and a non-governance coin. And you end up with these sort of loops that if you're in there at exactly the right time, yes, you can generate an enormous amount of real money. But every step along the way, there's the risk that you're the greater fool right before the bottom falls out, which is, what happened.
Yeah, and the way they present it to is interesting. And they talk about this is how much yield you can get, right? A 23% yield.
If it
on
all
Dave
works
coin,
perfectly.
23% yield on Dave coin. What's that worth in real life, right? Like, and then no, that's Bitcoin. Bitcoin versus. So it just becomes those big percentage numbers seem to attract that network effect. Right, you're just pulling in all that behavioral economics, all that work Amos Tversky and Danny Kahneman have done. They have really harnessed that for both good and bad in the crypto space, which I find fascinating. But anything to add to that, Matt?
Just that I agree with it. It is fascinating. I think it's important. There are positives to it, but it's a huge risk. For what it's worth, I'm structurally short Dave coin, have been for a number of years. No, I agree. It's a real concern, and it says something about the crypto space. There is a degree, particularly in the DeFi space, which I'm very excited about. Talk about why, but there's a degree of circularity and recursiveness in there that can make it appear larger than it in fact is. That doesn't take away from some of the really exciting technological breakthroughs and things that they can do in DeFi protocols. Those are still very real, but you do have this element of fluff and nonsense around it. For what it's worth, it's been in crypto for a long time. Used to be large problems with wash trading and issues like that. This is part of the anarchic mass that is the broader crypto landscape, and it's very real.
And I will add, I've said this before on this podcast, but there are also some very important use cases of understanding behavioral economics and your business model, right? So what I brought up before are companies like Helium or Akash, which require, for the business to make any money in the real world, it requires some sort of network effect. So Helium is just peer-to-peer networks where you place a little modem on the top of your second floor of your house to connect to another peer-to-peer network, because somebody else is incentivized to put that little modem there, right? How do you incentivize people to create these networks? This technology that has been around for 30 years that would benefit the world if everybody did a little bit of it for, a $300 piece of equipment. You're gonna incentivize them by giving them some Helium coin, right? So that incentive then leads to more peer-to-peer networks, the growth of actual real business, and the incentive for those who mine the Helium coins to keep them, which I do find in that community, right? So there are cases like that. And Akash is the same idea, but with cloud computing, right? That creates a more secure network where a single big organization does not hold all of your data, and you can kind of separate it as a more like a torrent style approach to cloud computing, right? So within all that chaos and madness, you see these gems where you're like, aha, this is a fantastic use case for behavioral finance, the coin and the crypto industry, and real world economics, right? So it's just a matter of finding them.
I love that so much. Yeah, you found a way to economically incent a decentralized network, which has been a challenge for a long time. And I think that's completely true. Just need to separate the gems from some of the other projects.
Yeah.
And so as you're going on this journey in crypto land, have you noticed any sort of corollaries that remind you of your journey in ETF land? And I mean, I think we've covered one or two of them, but are there any others that stand out as, hey, I know I'm on the right track because of X, Y, Z, that you feel are similar or not? Has this been a really kind of unique journey?
Let me think about that for a minute. There's certainly a few. One, I really do think I got to this point with ETFs where I felt like if someone gave me 4 minutes, I could explain to them why ETFs had a manifest destiny and would eventually take over the mutual fund space. It took me a couple years to get to that point, but I felt like I got to that point eventually. I think the same thing is true in crypto and blockchain. I think if I have 5 minutes, I can get almost everyone on board from this is an interesting thing that will have a major view in the future. And I think that's important because if you can boil something down to a pretty simple level and people sort of understand and get it, I think that gives me confidence that there's something real there. So that's one that I think a lot about. And we see similar things that we've seen before. I mean, ETFs went through waves of adoption by different groups of people. Crypto is going through waves of adoption by different groups of people. You see people who are very skeptical come into the light, and you also see persistent skepticism throughout. There's still plenty of people who hate ETFs and think they're going to destroy the world. And I think that will be true in crypto too.
Can I answer the question better? Because I think you missed the key one, right? Which is, if what we care about here as people who are marketing and selling products and stuff, right, which presumably you are, what you care about is where's that money coming from? Where's the people who are going to invest in this? It's following exactly the same arc that ETFs started with, which is you start really as sort of an institutional experiment. Then you have the sort of rampant, rabid early adoption by weirdos and freaks, which is totally what happened in the ETF market until about 2004, 2005, at which point financial advisors got the message. And with the financial advisors getting the message, the rest of the institutions realized they no longer had cover to put money places it didn't belong, i.e. hedge funds that were charging 2 and 20, et cetera, right? And all along the way, they were yelled at by regulators and skeptics who said, this is destroying the world. It's never going to go anywhere. It's a regulatory nightmare. But then this 3-part system of retail, advised, and institutional all ends up coming together, at which point it becomes unstoppable, which I would argue was the global financial crisis for ETFs, right? The survival of ETFs and the thriving of them in 2009 and 10 is the reason that it is now an unstoppable force. I don't think crypto's quite had that moment yet, but I just look at my own websites and I see the amount of traffic we get to anything related to the crypto channel we run. It's crazy, right? Mm-hmm. So it's clear that advisors are now very focused on this space. So it just feels like we're following the exact same mark.
So is that the reason why you've followed sort of the same tactics, Mac, in going after like the advisor space as the next targeted space? It seems to fit into Dave's narrative almost perfectly, right? If you think about the narrative of adoption that Dave laid out with ETFs and the way you have looked at Bitwise Investments and the partnership with LPL and some of the things you're doing to really nurture the advisor awareness and understanding so that in turn, I guess they can pass that on to the client assets. Is that sort of the same thing? And then I'm not supposed to ask 2 questions, but I'll put one on the end of that. Are you going to bring your conference expertise to bear at some point in that and start to do some sort of advisor crypto conference like you did with ETFs so successfully?
Yeah, I love it. Yes, it's part of the reason. I mean, a lot of us at Bitwise come from the ETF industry. I would say probably 70% of the people at Bitwise come from the ETF industry. And there's been a lot of crossover. And that is one of the reasons. The other reason was, and I still don't understand, it's underpenetrated. You have a huge number of crypto companies focused on self-directed investors, Coinbase, Kraken, etc. Self-directed investors don't have any money. So it's curious that there's this giant ecosystem focused on them. You also have VCs focused on true institutions, pensions, endowments, etc. A lot of crypto VCs. No one was talking to financial advisors who control as much money as those largest institutions. They just need different service. They need a distribution team. They need research. They need webinars. It's a different market. I think part of it is venture capitalists haven't discovered the advisor market. They don't know how large it is. And so we were uniquely positioned to move into that market.
I think they need that. One thing you missed that advisors need is they need access. They need access that's on their platform.
Yeah.
You got to navigate all of the platform access points. So you get to the advisor and the advisor says, oh yeah, I want to do that. And then you're like, okay, so what firm are you with? And let me start on that process. And maybe you can buy it in a year.
It's so huge. And you need people who are focused exclusively on that. I agree. We've been working, get on the Orion platform for years. And you make progress. We just got onto the LPL platform. Mm-hmm. Venture capitalists never probably heard of LPL, but it's 18,000 advisors and $1 trillion of assets. But I agree, you need all of those steps, and I think it's pretty unique. On the event stuff, of course, I love events. We're doing some around it now. I'm doing an event with Dave called Exchange, focused on the ETF space. I'm also an advisor to a company called Blockworks, which is probably the leading provider of financial professional conferences. They just launched a big DeFi conference for next year. They do a number of events. So I keep my nose in that game.
I love it. Got it. And so on your site, just since we're on the advisor angle, what are some of the top sort of pieces that people should read? Because you've got a bunch of resources on the site, but what's sort of, if someone's looking at this and saying, yeah, okay, fine, I've been beaten over the head, where should I start? Where is the in Bitwise, because it's substantial, the amount of information that you provide and the assistance that you're nurturing for advisors to educate themselves on this very frontier asset class. So where should they start there? What's the best place to go? And
great question. The first one's not even on our site. I was fortunate to write the CFA Institute's Guide to Bitcoin, Blockchain, and Crypto, which published in January. So if you Google CFA crypto, you can find that piece. It's about a 64-page introduction to the space. I think it's one of the better ones. Dave and I wrote the Guide to ETFs in 2015, so I was glad to publish that. The other, on the resources page, you can sign up and you'll get a monthly note from me that's email only, which I think is pretty helpful. We also have a paper on crypto's role in a portfolio, which I think is pretty good and emphasizes something that is dramatically overlooked in crypto, which is the importance of rebalancing. Rebalancing in crypto can transform crypto from a volatile asset to a big portfolio contributor. I'd start there.
Yeah. Say more. Would you want to just give them the highlights on that? Because I think, people do misunderstand adding a highly volatile asset to a portfolio that's non-correlated will improve the risk-adjusted returns of the portfolio. So can you say a bit more about
that's exactly right. The really unique thing about crypto as an asset, if you abstract away all the noise, is it has high potential returns, low correlation, and daily liquidity, which is not something that you typically get. Typically high returns, low correlation, you're locked up for 7 years in an early stage VC fund. Once you get liquidity, you can rebalance. And if you rebalance a highly volatile, non-correlated asset, as long as you assume it's not going to go to zero, which a bunch of people in crypto won't make that assumption. But if you assume that, it has a dramatic impact. You're harvesting that volatility. And the history of it is, if you add 2.5% Bitcoin to a 60-40 portfolio, there's never been a 3-year period where it didn't add to the cumulative and risk-adjusted returns. On average, over that 3-year period, it boosts the Sharpe ratio by about 50%, which is incredible. And it contributes about maybe 33% of the portfolio's returns on average from a 2.5% allocation. But the rebalancing tolerance is critical. Without a rebalancing tolerance, it leads to dramatic increases in max drawdown. The Sharpe ratio doesn't even budge, and it makes the portfolio much more volatile. So let
me push back on that a little bit, because to me, that is one of the critical problems with advisor adoption right now, is that most advisors are used to maybe doing a quarterly rebalance, which is really pretty insufficient based on your own math, which you were nice enough to share with me when you were doing it. Like, quarterly rebalance doesn't cut it in crypto, right? You got to you either have to be triggered or it has to be a lot more frequent than that. But that puts the advisor in this terrible box, because like Mike was saying, you don't get to just make that as a bucket trade for 400 of your clients, right? If you were going to actually do that, say with your fund or with a direct crypto allocation, like, that's an operational nightmare. And I know there's some folks out there like OnRamp that are trying to solve some of the problems, but is this actually viable as a portfolio asset for most folks, absent some sort of bridging mechanism like an ETF, like direct custody, something like that?
Well, an ETF will be a great thing. In the interim, you have these OTC traded trusts, which can trade at premiums and discounts, which are sort of like wrinkly ETFs. The short answer, Dave, quarterly actually does, at least on a historical basis, quarterly is sufficient. It's annual or semi-annual rebalancing that's maybe not rapid enough. But I agree that rebalancing piece is a challenge for advisors if you're dealing with private investments and you have to send 400 wires every quarter. Like, no one's going to do that. It's part of the reasons we need better access vehicles. For what it's worth, it's part of the reasons people buy funds like GBTC or BITW, despite and understanding the premium and discount issue, because the rebalancing capability can overwhelm that risk. And so a lot of people think people buy those naively. Most advisors fully understand the premium discount risks that attend those products, but the ease of use, the ease of reporting, the ease of charging fees, the ease of rebalancing more than compensates for the necessary hair on those. So I think it's positive. The other thing I'd say for advisors, if you ask your clients, most of them are buying crypto anyway. So
Right.
you might.
I think that's my biggest point is you have a fiduciary responsibility, not just on the assets that you hold for your clients, but you also have to know what they're holding elsewhere and advise them on that. And if you're the advisors that I've heard say, oh, it's going to go to zero, it's garbage, it's not worth it. Those guys talk to me and say, well, how do I buy off outside of my brokerage account, right? And then I have to be like, oh my God, like this is not. I talk to you're going to blow yourself up. Like there's so many ways that could go wrong, but they're doing it anyway, right? So then I don't give them advice, and then they go and blow themselves up and put in way more than they should. Yeah. I think advisors who recognize the risk to their clients' retirement needs, recognize the potential asymmetric upside, and can provide liquidity, need to act. You just can't sit there on the sidelines anymore. You're doing a disservice to investors. And by the way, like let's assume that it has a possibility of going to zero. 1 to 2% allocation isn't going to be the end of it all. And as we know from some work that we've done, even on the way down with high volatility, if you're rebalancing enough, you're scraping and you're harvesting volatility premium while it's going flat to up. That might offset a total loss of 2% down the road, right? So these are the things. This is the professional right. Asset management are required. So without any opinion, what you just can't ignore access to an asset class like this.
And on that note, Dave, what have you guys, because you mentioned that you guys are publishing some crypto research and whatnot, and you've worked with Matt. So what have you guys got that investment advisors should be looking at? Is there anything that's complementary to what Matt mentioned and that would help advisors continue to educate themselves?
Yeah, for the most part, we're in the business of providing investment information to advisors, helping them down their research journey, whatever it is. So we stood up a crypto channel, and we're discussing all of these things, article by article. So it's much more, day-to-day news flow. But, in that channel, you'll find articles about how to access these things and Matt's so-called wrinkly ETFs and the tax implications and, how advisors should be thinking about DeFi. And so, we're covering all of those bases, and I think you'll see us continue to grow that as advisor adoption continues. But we did that not because we're trying to get ahead of the game, but because of demand. We did a survey with Bitwise over the last couple of years, and advisors want this content, right? And while the name of our site may be ETF Trends, and we don't necessarily have the non-wrinkly version of those ETFs trading yet, we'll get there eventually.
Yeah. So let's talk about the tax implications for a second, because those are interesting. Everybody seems to be confused. What are the tax implications, and is there any difference between holding them outright and having to report and the type of slips that your fund would give out?
Well, the first thing people should know about crypto and taxes is if you buy crypto and it goes up, you have to pay taxes. That's surprising that many people think they live outside of the tax world, but that's not true.
Upon IRS, sale, or is it marked yearly, like in the 60-40 rule in futures?
Great question. The crypto is taxed as property, which means effectively it's taxed like equity. If you hold it for more than a year, it's long-term capital gains. It's taxed only on sale. It's not taxed like gold, which is taxed as a collectible, even though people call Bitcoin digital gold. It's not taxed like futures and mark to market, unless you're buying crypto futures, in which case it is. But traditional crypto assets are taxed as property. The two wrinkly bits, wrinkly seems to be my word today, Dave. The two wrinkly bits are, there's a little bit of confusion around tax loss harvesting and a little bit of lack of clarity about whether you have to have a 30-day delay when you harvest taxes. There's debates around that. And there's some confusion around airdrops and hard forks. The way we handle it for our investors, we issue a K1. We're very proud. We've always gotten our K1s out in February or March. It's an extraordinary achievement. And so we make it easy for them to file taxes on it, make it very simple. But there is more confusion than there should be. Mostly they're taxed like stocks.
Yeah, but isn't the wash sale thing, the issue here is wash sales, right? So you can sell your Bitcoin down a bunch and then theoretically buy it back the next day and get the reset on that basis, book the loss now, offset it against your, ARKK that went up a bunch, whatever. I get that there's no positive ruling on it, but there also hasn't been a negative ruling on that. And that is currently how property is treated. So are you actually concerned about an IRS clawback, or is this just mostly an issue that this could change any time, which that I agree with. I think it could change any time, but it's hard for me to see how they can simply say, well, Bitcoin is a different kind of property, so you have a 30-day window. You still have the sham transaction issue, which is true throughout the tax code. You can't make a transaction for the purpose of avoiding taxes explicitly with no economic gain. That's fraud. That has nothing to do with what asset it is you're trading.
No, that you have it right, Dave. There's just risk and uncertainty in the future, right? Because from an outside perspective, you'd be surprised that you can do that sort of non-30-day harvesting, right? It doesn't make sense from a first principles perspective, even though I agree that's how the tax law lines up. So, I'm not a tax professional. I just think people should be careful about that and careful about how much they rest on that understanding.
Right. But if you are somebody who's like one of these crypto degenerates who's out there day trading Bitcoin all day, it significantly changes how your taxes work, right? You can't just plunk those transactions into QuickBooks and call it a day. Like they are fundamentally treated differently in terms of how you deal with the gains and losses.
That is definitely true. I will say the IRS's FAQ on crypto taxation is the best thing they've ever written. It's actually shockingly clear. It's even kind of clever and cute. I mean it. Of every piece of IRS writing of all time, the FAQ on crypto is remarkably good.
I dare say nobody's ever said that the IRS has written something clever and cute in their entire
There's some like 24-year-old.
I'm legitimately going to read this over the weekend.
That's a new string of words.
I'll read it to my daughter.
Never been said again. Millions of monkeys couldn't have come up with that.
Exactly.
It is true.
And is this because it just provides it covers most of the major loopholes and the clarity that is required? Because that would be news to me.
It doesn't cover the nuances. It doesn't cover things like airdrops and hard forks and exactly how those should be handled. And those are very complex, right? What if there's an airdrop but you never claim it? Did you actually receive that value? Should you have to pay taxes on it? It doesn't get into those things. But in terms of the basics, in terms of 98% of the tax rules that impact people investing in crypto, someone who buys Bitcoin and Ethereum and sells them a year later, it is crystal clear about that.
Right. Okay, that's interesting. Got to take a look at that.
Yeah.
The tax conversation's already got me a little bit sleepy.
Have another drink, Mike.
There you go.
Well, don't worry.
We stop talking about tax for a minute.
We can peel out.
Let's talk about the fact that Dave called you a crypto day trading degenerate. How about that? He was looking straight at you.
I wasn't looking at Mike.
I didn't
You were looking at me?
respond because I'm I don't know whatever that means.
Degeneracy, not familiar. Sorry.
Okay, so let's talk about the risks here. Just generally, like you said, there's a crypto world that believes people that talk about crypto that believes it's going to go to zero, right? And so as time goes by, and one would have expected ETFs to be approved by the regulators and governments back. It just time keeps going by, and we don't see any movement in the United States, the most powerful nation on the planet, also has the most powerful currency on the planet. Where do we see these dynamics going, and are we starting to falter a little bit?
That's a fun question. I think the ETF question, I'm not actually concerned with the pace of progress in ETF land. So there are people in crypto who have a view that the SEC hasn't approved a Bitcoin ETF because the Fed is worried about Bitcoin taking over for the dollar. I think those people are a little self-delusional. Bitcoin is a long way from replacing the dollar. And I don't think there's like an explicit don't approve an ETF. Dave and I have lived through ETF approvals forever. They take forever in the US. Canada is always ahead of us by 2 years. That's been true since the founding of an ETF. It's still true today. Bonds took like 4.5 years to get approved.
Non-transparent active, 7 years.
Exactly.
Which one?
Right. Non-transparent
active.
Non-transparent active, which is just like an active fund. We've had, I think it's 16 meetings with the SEC over the last 14 months, and we don't even have an ETF filing right now. They're extremely engaged. They're asking very good questions. I think we're close. I think we will get there. So I'm not worried about the ETF specifically. I do think we will get over that hump. I will say there is a broad push right now, by which I mean this moment, from every major US regulatory agency to develop new standards around crypto regulation. And I think those standards are going to have a big impact on the stablecoin market. I think they're going to have a big impact on part of the DeFi market. I think they're going to be very positive for parts of the crypto market and very negative for other parts of the crypto market. But regulatory risk and how that regulation breaks over the next 6 months is going to determine whether we're in a generational bull market in crypto or whether the industry faces real challenges. So outside of the ETF, I think there are big regulatory things to discuss.
Can we unpack that a little bit?
Mhm.
What are those things that are the big pain points for them?
Well, so I think they're very worried about stablecoins, right? Stablecoins are crypto representations of dollars, is one way to think of them. And there are varying qualities of stablecoin providers. The largest is unfortunately the worst quality, Tether. And these are large, 50, 60, 70 billion, $100 billion. And there's concern both about whether there's systemic risk there from those assets, say owning commercial paper and unraveling and having to dump that paper and impacting the market. And they're just generalized concerns about how should these private versions of the dollar be regulated. And they form an integral part of the crypto market, right? They are where people withdraw from crypto's volatility to hold money in a stable asset. Yeah. And they provide sort of the liquidity that interweaves it all. So I think regulators are I don't know what they're going to do in that space, but I think it's going to change. My guess is it changes for the better. Like, I actually think the removal of poorly regulated stablecoins removes a major risk in the crypto market, and a risk that could cause violent deleveraging in the DeFi space if it went wrong. So I'm in favor of it, but I do think it'll be a painful journey. I think they could overreach. I think there's risk there.
But that implies, sorry, I got to call a little BS on that. That implies that what we get for regulation is this sort of clear regulation about what a stable coin has to be okay, and that is allowed to then go do the things that stable coins are currently doing, which is largely working in liquidity pools. That's the primary use case for a lot of them, right? They're parking places for movement of liquidity in other crypto ecosystems. Gensler's comments about the swaps markets, about the derivatives markets the other day was the clearest negative indicator I have heard from the SEC yet, that they believe they have regulatory oversight. The way I interpreted what he said was, hey, you're trading a swap against Tesla at FTX in Germany. You are regulated by the US because Tesla is a US listed stock. So if you're running a derivative against it, we get the call. That was an eye opener for me.
Well, So to be clear, Dave, I was just saying that I think their first focus is going to be on the stablecoin market. I think their second focus is what you're talking about,
derivatives.
And I don't think there's a pathway for those synthetic stocks in their current iteration to survive. I think regulators are going to make that. It's such a clear intrusion on their regulatory footprint, right? There are synthetic versions of oil that trade, and they aren't registered with the CFTC. I just don't think that unfinished circle is going to stay unfinished. I don't think it means that there isn't something that emerges out of that that's interesting and important. I mean, to step back for a second, FTX created a way to trade U.S. stocks 24/7, 365 and have them settle instantaneously.
Which is brilliant.
Yeah,
it's I'm all in. Like, let's just make that our market system and I'm done.
Right,
yeah.
Right. I think we need to pause and point that out, that New York had hundreds of years to figure it out, and they're still trading 6.5 hours a day, 5 days a week, some weeks. So we should give them a lot of credit for that. But I do think it's going to have to evolve to a regulatory pathway. I think it's really interesting, for what it's worth, that FTX was able to close a $900 million venture round amidst this regulatory uncertainty. I think that's an interesting point that I'm still working around in my mind.
Well, I think what we're seeing, as always, is the ecosystem in the crypto space has allowed entrepreneurship to just grow untethered, right? So what you end up getting is a bunch of signals of, hey, world, this is how it should be, right?
Yeah.
And then the regulators have to come in and like, okay, we have to change, but let's do it in a way that we can regulate. And possibly, I mean, what's all these stable coins were out of necessity. We're out of people wanting to get out of the volatility of crypto, park it, move it from one place to the next. And you could choose to go in FTX and hold your USD, or you can choose Tether. But when you try to transfer it from FTX to Kraken, one will take 7 days and you might not get your money, and the other one takes 20 minutes, right? And so it's what happens when governments, and the U.S. government creates a U.S. government crypto coin that has all the same facilities, but actually has some sort of regulation and backing that can transfer in 20 minutes. All of a sudden, I think naturally you're going to see people moving towards the more certain of the two. I'm assuming that most of the new adopters aren't terrified of, the government spying on you and all that stuff, right? So just assuming that it's regular people wanting to be in that space, they will likely choose a regulated, efficient coin than a non-regulated efficient
people
coin.
will use it.
Yeah.
Like, and that's the thing that's slightly scary about the Chinese central bank digital currency, is that it is explicitly being designed as a command and control vehicle for the CCP. It is not really designed to solve the entrepreneurial problems of the crypto class. People are going to use it like crazy because it will be very convenient, because it will tie into everything else in their financial world. The thing I worry about with a US CBDC would be the same thing. It's like, if they launch one, everyone will use it almost regardless of what's under the hood. We might talk about the hair that's growing on it, but if it's convenient, if I can move it in and out of my Visa account, my bank account, and then I can use it to go do some crypto fun thing, and then I can pay my landlord with it, it'll just be 100% adoption, regardless of what they decide to bake into it. That's awful. And that's what I worry about.
I agree with that. I mean, my biggest concern about the U.S. is they're going to be too slow. And they're going to get passed by on this out of reticence. And they're going to be too careful because, obviously a federal stablecoin is a severe threat to traditional banking systems, depending on how it's designed. And so I think the U.S. is going to move slow. But I think it's inevitable. I think everything's moving that way. There's no way it doesn't end up in that place.
Yeah, I mean, like, how does the euro dollar market work, right? Like, you have a bunch of banks that are creating dollars out of nowhere by lending them out, right? You can also regulate another other group of people that are using your dollars in ways that are useful to the world and to them, right? So it might not just be one or the other. It might be the same thing as we see globally today.
I agree. I was sad the U.S. didn't jump on board the Libra Diem train. I thought that was the best single way to extend the U.S. dollar's dominance as the world's currency, and we just blew it. Which is a shame.
Yeah, no kidding. I mean, it really is the derivative markets that's driving a lot of this bull market, the demand, the liquidity, and one of the use cases is the fact that the rest of the world can't trade in New York time when they want to get access to Apple and Tesla, right? So they're providing a service to the world that wants to grow their wealth and participate in the best technologies in the world when they're too small to go to a broker dealer in India, get them to pay attention, open up an account, and be able to trade what they want at the time that they want, right? So it does answer a question. It does create some use cases that we're going to have to grapple with and deal with. Rod, I see no other way.
Let me ask you, Rod, I agree. I think the derivative markets are the most interesting thing in crypto right now, and I think they are driving an enormous amount of what we're seeing. But at the same time, can you just strip all that away and say, actually, all this is access to ridiculous amounts of leverage? Because that's what I see when I start peeling back that onion. It's like, it's not that trading futures this way is so much better and, giving you access to betas you could never do derivatives against on the CME. It's that you can get 100x leverage without really trying very hard.
Well, okay. So if you look at the actual numbers, and Matt, maybe you know more than I do on this, the actual 100 times levered guys represent like less than 1% of the ecosystem, right? So, Dave, let's not exaggerate. Come on now.
Okay,
no.
Levered guys I think 1% of the system, then they're 100% of the notional. That's the whole problem.
Let's take a second. Let's take it back. I think the use cases for the derivatives market oftentimes aren't leveraged. if you're going to choose to trade Bitcoin straight up or trade the perpetual is more liquid. Yeah. It settles instantly. You don't have to wait for. So it's like a second layer, right? That becomes a way to get exposure to those markets. So it's not as massively explosive as one might assume, but certainly some regulation would probably help, right? I mean, we need to get in there and
just
say
to keep up with the margin calls. Yeah.
Well, that's the other thing. The self-clearing nature of the margin calls is kind of interesting. But on this, I want to go to Lightning, the Lightning Network, and the adoption that's happening there too, in that layer of payments and being maybe more of a threat to the sort of the dollar dominance in everyday payments. What are your thoughts on that?
I think there are two ways that crypto can penetrate the traditional payment use space, or maybe three ways. Lightning is a good example. So the Lightning Network allows you to throughput a lot more transactions much more efficiently than you can if you have to write every one to the blockchain. So it makes Bitcoin more functional as a cryptocurrency. And there's a lot of sort of layer 2 side chains that do this for other assets as well. I do expect Bitcoin to become more of a transactional currency on the margin. I think you already see it tackling places where traditional fiat currencies are truly atrocious, like remittances or in certain capital controlled markets. Over time, as the volatility declines, as things like Lightning make it more usable, I suspect it will eat into more and more of those markets. And I think there's a non-zero chance that over politicization of fiat currencies causes the world to want an apolitical currency, and you could see a step function increase in interest in Bitcoin. For what it's worth, I don't think it has to penetrate any of those use cases to be a phenomenal investment, but I think those are gravy on top. And I think it's indicative of the level of innovation, the speed at which this is being adopted and the speed with which new technologies are being built is really it's kind of breathtaking. And probably going to accelerate as more VC money comes into the space.
Oh yeah, just like look at the Overton window of sort of the general zeitgeist of 12 months ago to today. It's breathtaking. Yeah. How much this has moved from, if you're an advisor, an allocator, or an individual who's talking about this asset class 12 months ago. July 2020.
You were a lunatic. Yeah.
Correct.
Yeah. And now you're one of those guys who's a little on the edge.
Yeah.
Which is very much like that ETF sort of journey.
Yeah, no, it's like, you're right. I mean, it is the Overton window shifting what is acceptable behavior. And all of a sudden it's like, well, MicroStrategy straight down the middle. I mean,
Yeah, exactly.
You don't have 10% MicroStrategy? What's going on, buddy?
I will tell you, it's so true. The percentage of advisors who ask us about will it go to zero has vanished over the last year. And the flip side of that is the average allocation of a Bitwise client, I think, has gone up from about 1% to 2.5% of their portfolio because that binary risk has disappeared. So I think that is a very real material change. And I think it's driven by a very real and material diminution of these binary risks. Crypto really did live by a thread for many, many years at a level that many people don't understand. It could have gone to zero almost instantly for the first 8 or 9 years of its existence, and it didn't. And I do think we're past that point now.
And is that partly to do with the DeFi space, the different crypto coins, and that general ecosystem that is kind of creating different use cases and opening people's eyes to the new technology?
I think that's definitely a piece of it. It's gotten a second story through DeFi and things like Uniswap, which I think is the greatest entrepreneurial story of the past 10 years. But even more basically, I'll tell you a story about Bitwise. Bitwise was an early startup. It was backed by some of the leading venture capital firms in the world. Vinod Khosla and Naval were invested, Craft Ventures, Catalyst, General Catalyst. We couldn't get a bank account to make payroll because there were no banks that would provide payroll services to anyone involved in the crypto space. This was 2017. At the time, there was one bank who would do it in the whole nation. When I talk about like crypto living by a string, that's the kind of example I mean. Today, dozens of banks, anyone will do it. But even 4 years ago, an asset management company backed by blue chip venture capitalists with people with 20 years of experience in financial services couldn't pay payroll to provide funds through Wilson Sonsini as the lawyer. I mean, it's insane how
the fertilizer wasn't there.
Exactly. It's insane. It's insane. But all that changed now.
Were you like a construction site on Friday with the envelopes full of cash for everybody, or what did you do?
Everybody got a USB card?
That's right.
I'm reminded of my days working on the farm and going to the labor pool, picking up all the labor, and then having to pay them at the end of the day with the cash.
It's so true. It was brutal. It was brutal. We had to call on a bunch of big favors in order to get a bank account. Which is amazing.
So
that's all
where are you seeing flows in Bitwise? You got a suite of products. And so where are you seeing the general emphasis of interest, if you will? And maybe where do you think that if that's not the right place to be, where do you think the next layer of interest would be? Or what are you seeing now? And what do you think might be the future area of opportunity?
Yeah, sure. So most of our assets are in our large cap index fund, the Bitwise 10, because most of our clients are financial advisors who just want beta exposure to the space. I will say that our DeFi index fund, which launched in February, was much faster out of the gate to grow. We pulled in more than $100 million in a private placement DeFi fund in the first 6 weeks it was on the market, which is very fast for a private fund. By comparison, it took 3 years for our index fund to get its first $100 million. In terms of, I mean, most of my money is invested in our index fund. I'm really personally excited about ETH. I think ETH is the crypto asset of the summer and maybe of 2021. And so if I were an advisor looking outside of the large cap core, I think there's a lot to be said for focusing on the Ethereum space right now. It's going through a few technological upgrades, which are really big deals and really smart. And I just think it's a phenomenal ecosystem. For what it's worth, they're more like off-piece down the road stuff I could talk about, but I really do love ETH right now.
So let's talk about ETH and why you're excited about it.
Yeah, 3 reasons. One, everything in DeFi is built on ETH. So it's fair to think of ETH as the internet that DeFi exists on. So if you're excited about DeFi, you should be excited about ETH. 2, there are 2 major technological upgrades coming in the next 12 months. One of which is coming August 4th, which is called EIP 1599. EIP 1599 is an upgrade to the ETH software. It makes it easier to use in a cool way. But the great thing it does for investors is it changes what happens to the transaction fee. Currently, when you can transact on the Ethereum blockchain, the fee goes to the miner, who typically sells it. After EIP 1599, the base fee will be burned. You can think of it like a stock buyback. It turns ETH into a consumable commodity like oil or gas. So in order to run DeFi on ETH, you have to burn ETH. And I just think that makes it so intuitive as an investment. I think it's going to bring a lot of institutions in. And then
walk me through that again, Matt. Sorry, before you go, I want to fully understand that.
Yeah. So right now, if you're processing a transaction on the Ethereum blockchain, right? So if you're using Uniswap and you have to write that transaction to Ethereum, you typically pay a transaction fee, right? It could be 0.01 ETH, it could be 0.02 ETH, it could be some small fraction of ETH as a tip to the miner to process your transaction. Today that goes to the miner and they typically sell it because they have to pay for electricity, they have to pay for mining equipment, etc.
Exchange it for dollars.
After this upgrade, the miner continues to get newly minted ETH. That's the other way they're compensated, the same way Bitcoin miners do. But this transaction fee, instead of going to the miner, the base fee is burned or destroyed forever. It's like you're putting gas into the ETH engine and it's consuming it. And I think as an investor, when you think about ETH today, it's abstract as an investment. What are you buying when you're buying an ETH token? You're buying like a stake in this protocol, and how is it monetized? What valuation characteristics? Hard to think about. But if you say you're buying this gas that powers the internet of finance, and every time you want to do a transaction, someone has to pay in that gas, I just think that's a very intuitive way. It also reduces ETH's inflation. If you think about the Bitcoin halving,
That's what I was going to say.
a lot of people attribute Bitcoin's run to its halving. This is about half of a halving.
Right.
So it will reduce ETH's inflation from 4% a year to about 3% a year, which is a material reduction that no one is talking about. And then the second thing, just to finish, and we can keep going, next year we're supposed to evolve. I'm not part of ETH. ETH is supposed to evolve. That's decentralized. Maybe I am. ETH is supposed to evolve to ETH 2.0, which everyone's excited about this trend, this move from proof of work to proof of stake, which will move it to a carbon neutral consensus mechanism. But that will reduce the inflation from 3% to 1%. So ETH's inflation rate is going to fall from 4 to 1% over the next 12 months. That's like a halving and a half. And I think that's a very big deal in terms of the supply-demand dynamics. And I'm pretty excited about it.
Yeah, and I'll just toss in there, like, I think when first of all, I called Matt an idiot when he made the jump. So I was clearly wrong about that. So, but because of knowing Matt for all these years, like I read all of this stuff. I have to, it's in the contract. And so I read all of his stuff about it. And I went down the Ethereum rabbit hole really tightly and really, with a lot of depth. And I think you're underselling it, right? Because it's easy to look at it and point out all of its flaws. Oh, you could write a smart contract network better this way or that way. But the network effects are so profound when we start talking about actual utility, right? Because that's the difference between Ethereum and virtually everything else. Ethereum provides a utile service. And that's what's really unique about it and what's different. And that utility is explicitly tied to the size of the network. That's something that's very difficult to usurp, right? You can write the better Ethereum version. There's 100 of them out there. And some of them will find their use cases. They're hyper secure, they're faster, whatever it is. But I don't think anybody's going to step in and, MySpace Ethereum anytime soon. It just doesn't feel like it. And the protocols itself and Solidity and the ways you access it are just elegantly designed from top to bottom, right? So, to me, this is a case where open source works.
Yeah. The key issue with developers right now happens to be the cost of them being able to transact and anybody be able to transact right now, right?
Just gas.
And then the second thing is it's slow, right? So that's going to be dealt with in 2.0 as well. The issue, of course, becomes, from what I gather, that they've been promising you 2.0 for a long time, right? So you got the developers kind of holding on, and finally some just splitting off because they got a business to run, right? Going to Cardano or an ADA or wherever, whatever other coin makes sense for them. So it'd be interesting. It's going to be interesting to see if they can deliver on some sort of timely transition for the vast majority of the ecosystem to stay with them, right?
I agree. I agree. That is the big risk.
Yeah. Well, that's super interesting. So you got your second.
I might just weave in Steve's question. So do you see the correlation between Bitcoin and Ethereum to remain high in the future or continue to decrease? And I wonder if some of the comments that you've made here would lead you to a conclusion that the correlation may decrease in some way or not. I lay it at your feet to answer. It's on the screen there.
Great question. It's definitely, I shouldn't say that. The lawyer just, kicked me in my head.
It may
I
be.
think
It could be.
It may. I think the correlation is likely to decrease over time between all crypto assets, but particularly between Bitcoin and ETH. Between all crypto assets, because the sort of industry-wide risk has diminished so much, as we discussed. And it used to be that overwhelmed any coin-specific utility. Between Bitcoin and ETH specifically, for the reason Dave mentioned, Bitcoin as a technology and as an asset is really optimized for the store of value use case, potentially the transactional use case. ETH is really optimized as this useful other blockchain. And I do think as we see more utility build in ETH, the correlation will drop. They'll still be correlated, like 0.7, 0.6. But I think they'll be correlated in the same way that Microsoft and Salesforce are correlated.
Right. What you were saying triggered something for me in that in this early development nascent field, frontier asset class, you're all gonna be together and you're all gonna have very high correlation because the economic utility that you might provide is going to be overwhelmed by the liquidity in the space. But as the economic utility of the business models that you might provide to different business cases deviates and creates a dispersion, then those business cases are going to provide a different sort of discounted cash flow or some sort of expected growth in the future that have structural relationships that are different from one another. And thus you're going to get a proliferation of non-correlation through the space.
I think it comes down to the commonality in risk right now in the crypto space, right? It's that lack of fertilizer for a great seed, a great idea. All these seeds require that fertilizer to be set, which is proper regulation, clarity in taxation, banks that are willing to onboard and offboard. As that becomes better and better, now you worry less about the big Armageddon event, and you start worrying about the specific company events, right? That's when I think we'll start seeing very, very unique diversification in those assets.
I agree. Well said.
Love it.
Okay, so let me ask you. Right now, I'm looking at some of the funds and everybody that's in this space and trying to index all this stuff. And we talk a big talk about diversification and market cap, and then you get into it. And currently today, and this is going to change in the future, I'm sure, it's basically like 90% Bitcoin, 5% Ethereum, and then 20 like 0.3s allocations to the other asset classes, right? So, I mean, the concept is there. Where we are right now is not necessarily that level of diversification that one would consider. So how do you see that evolving?
Yeah, I think I think it's likely to change over time. Yeah, our index is maybe 65% Bitcoin, 30% ETH, and the rest is small assets. I think it is likely to change over time. If I were a betting man, I bet ETH share will grow, and I bet you'll see some of these DeFi specific apps like Uniswap accrue larger market capitalizations over time. But it is a network effects business. I think the largest will remain the largest. The real advantage of an index strategy is it doesn't matter how it turns out, right? Like sure. If the Bitcoin maximalists are right, it's all Bitcoin, then the index will be all Bitcoin. If the flippeningists for ETH are right,
that's right.
Then it'll be
I love
ETH.
the flippeningists.
Flippeningists. I had to pause for a minute on that. But I do expect more diversification in that mix over time. I expect Bitcoin's dominance to drop. It's just further along in penetrating its use case than these other assets. Like it's pretty far along the chain of being digital gold, even further than ETH is to being the internet of finance. And that's why I think its market cap is as high as it is right now.
And can you tell me more? I am really interested in hearing why you think Uniswap is the most compelling entrepreneurial case in your lifetime, or whatever you said. Why are they so special for you?
It's so amazing. So Uniswap, for people who don't know, is a decentralized exchange. You can think of it as a decentralized version of Coinbase, where any person can be a liquidity provider. It's trading like $50 billion in trading volume a month and generating a couple $100 million in fees. There have been weeks where it trades more than Coinbase, just $60 billion publicly traded company. It has 0 employees, 0 offices, and no CEO. I just find it hard to imagine a startup that didn't exist 3 years ago that is today generating hundreds of millions of dollars of monthly fees and trading $50 billion in volume is challenging one of the most successful IPOs of all time for trading volume, and is doing so with no employees. I mean, it's mind-boggling.
Well, and more to the point, they're sort of like the vanguard in the space, because the people making all of those fees are the people participating in the process, right? It's not all just accruing to, Jack.
So talk a little bit more about that, Dave.
Well, so I mean, the whole idea, what Matt's talking about is Uniswap is fundamentally just a protocol. It's not a company in the way we would think about it. And as such, it's just a way of enabling these mediums of exchange, right? I don't know who was first, but they're the popularized version of the simple liquidity pool, right? Certainly one of the first examples I'd ever seen, where people stake different assets and you allow the market on some curve to determine whether or not you're booking arbitrage on either side of it. I mean, it's fundamentally the creation redemption mechanism for ETFs on steroids. And, it allows people to both create anything they want to trade, any two items they want to trade against each other that can be tokenized, can run through the Uniswap protocol. And the fees that come out of that accrue to anybody who wants to participate, which is a little bit like Vanguard. If you are an SP 500 index investor at Vanguard, you're effectively paying at cost. And to the extent the company happens to be really efficient at it, that cost just keeps going down, right?
Yeah.
So Vanguard doesn't necessarily pay me to be in that business, but hey, you know what? Add on securities lending revenue. And in fact, a lot of times they do. And so I think Uniswap is a classic case for decentralization actually vanguarding the rest of the financial services industry.
Yeah. And I would just add, like, the Uniswap thing really woke up for me. I was talking with the lead trader at one of the top crypto hedge funds in the world. He said he migrated most of his trading to Uniswap because he was getting better prices. So not only is it disruptive in the way that Dave mentioned, but it's disruptive in terms of its ability to deliver prices. I really do think if it was started by, like two guys from Silicon Valley, they'd be on the front page of the Wall Street Journal. It just happened to be started by a guy who wears a tatty unicorn shirt. And so it doesn't get as much attention as I think it should.
Right. So these guys are, any market participant can go in, find a crypto pair that, let's say, they own one half of the pair. They add liquidity as a automated market maker. So this is kind of like the idea: you're putting your liquidity in and provide for staking that coin and allowing other people to trade in and out and creating that balance between the two, the pair. You are getting paid while you wait.
Yep.
Right. So it's
just like any other market, the more willing you are to provide liquidity on something that is otherwise illiquid, the more money you're going to make. So it encourages exactly the kind of risk taking that encourages the economies of scale and the network effects we know you need to get to make these things work. But it also makes it really lucrative for what I would call more traditional institutional market making type activity.
That's exactly right. It also solves a future problem, Dave. If you think about in Europe, you can pay market makers to tighten liquidity spreads on ETFs, and you can't do that here in the US. One challenge when people talk about tokenized assets is how you'll have liquidity in this huge fracture of tokenized assets. Well, this is one example. If you had a tokenized asset or were supporting an ecosystem, you could provide liquidity to jumpstart liquidity in that market in a direct way, which you can't do in traditional markets. And I think that's sort of like an elegant add-on that people haven't even gotten to yet.
That's exactly the type of innovation that's coming out, and that's only like the tip of the iceberg. In so many other ways, the best and brightest minds are going in and coming up with use cases. It's very exciting. And
how much is the regulatory pushback we're getting being driven by the old guard and their money and influence?
Not yet.
No, now what's happening now? I don't know. I actually don't know the answer to the question. I think it's a sort of a very touchy question, maybe. But how much do we think that the regulatory pushback is driven by the old guard?
I think they're pushing for very aggressive regulations. I think is the answer to that. And I do think they're afraid. And I will add, there's every risk that regulations are overzealous because they can be story driven and politicized and not based on technology, and you see some elements of that. So I do think the old guard, I think some of them are ignoring the crypto and DeFi markets, and I think some of them are worried about it. And I think a vanishing few are embracing it because it still seems too foreign to them.
The good thing is the constituents in the voting base are jumping into the boat, and so the influence peddlers will be peddling different influence as the aggregate of voters changes. Anyway.
Yeah, that's interesting. I think, Dave, you said that this was adopted by institutions and retail. I kind of feel like the adoption is mostly retail. Like retail has really led the zeitgeist here, and a lot of people have it. They are voters, and if the government is going to getting between them and their Bitcoin, it's going to be a problem, right? On the DeFi space, people that can't get credit cards can get a credit card if you own Bitcoin, and like Crypto.com will be offering something like that. And there's a few places globally that allow you to, if you have bad credit, to actually be able to participate in traditional markets through credit cards that are backed by Bitcoin. So all these things that are making things easier for Americans and everybody in the world, you take that away, there's going to be some voter lashback.
I'm taking the under on that one. The American voter is
Nice.
not showing up to kick people out of office because they don't like what their financial regulations
Ever.
are.
Hold
Never
on
in
a
a
second.
million
This is not,
years.
you're missing regulation
I love
versus
it.
wealth accumulation. Like this is the opportunity for them to wealth
There will be
accumulate.
a very small percentage of Americans who are both in crypto and connect those dots. But yes,
Although you are seeing
know.
you're
Not sure.
seeing activity from like the mayor of Miami, from various states,
Wyoming.
Wyoming, parts
Yeah.
of Texas, that are
Texas.
trying to be very pro crypto.
I think it's gonna happen, and I think there will be a lot of pressure on regulators. I just don't think any of them. I don't think we're gonna like have a presidential election lost over a stance on crypto regulation.
Right.
We'll see.
Well, it'll be more than you think. I think there's
it
enough
might
people.
show up on the
Yeah.
agenda as item 37 down on the fifth plank.
It's going to be right next to legalizing marijuana, my friend.
Done. Check the box. It's already done.
Oh, is that
Biden
already
did
done?
it.
See, the
Yeah,
next
federal
up,
thing
crypto.
done.
Next up. I love it.
All right.
All
Well,
right.
I
There was
think
there was one earlier question that was a bit technical, and I didn't want it to disturb the flow. But there was Bob H asked, how can in the Bitwise 10, why is ADA or Cardano included over Tezos and with the fork and whatnot? I don't know if you can comment on that, or if you've. I'm not sure you can or can't, or what. But please.
I can definitely comment on it. Cardano's included because it has a larger market cap. The criticism that Bob is making, that there isn't a lot of development activity on Cardano, is accurate and a topic of great conversation in the crypto markets. It checks out as a cryptocurrency from a fundamental, and as a blockchain from a fundamental sort of technological functioning aspect, and from a security aspect, and from an ability to custody aspect. So as a market cap weighted index, we just have to take the market's view. Tezos has been a component. If they're successful, I hope they'll be a component in the future. But right now they're outside of it from a market cap perspective.
Great. And then one of our own beloved Richard Latterman asked about that. Well, Cardano's role in DeFi and competing with Ethereum, but probably
I think we
similar.
covered that.
Yeah, it's a slick blockchain, very performant. And the question is if it can catch up with Ethereum's, network effects, developer community, brand, and recognition. And that's what makes it fun to watch. We'll see.
Absolutely. Love having a horse race where you've got all the horses in the race.
Exactly.
Well, we've been at this for an hour and 22 minutes, guys. I think that's been a great Friday, and I really appreciate you coming, joining us, and Dave co-hosting. You've done a fantastic job.
You couldn't
really
keep me
appreciate
away.
that.
An opportunity to poke fun at Matt.
I love it. But before we go, first of all, everyone listening, please hit the like button before you go. Share this with somebody, all that good stuff. And then I just want to go through for Dave and Matt where people can find you, any recommended spots that you want them to look at or educate themselves on, etc. So maybe Dave, hit them first.
I'm just all in on Twitter, at Dave Nadig on Twitter. You can link to my stuff and then my profile page there over at ETF Trends.
Perfect.
Yep. And for me, at Matt_Hougan, which is Hougan. It's got that funny U in it. Or come to bitwiseinvestments.com, sign up, and I'll send you my monthly notes from the CIO.
Love it. We all know where Rodrigo's from, so that's fine.
That's right. I got the worst Twitter handle of all time because all the Rodrigo Gordillos were taken. Rod Gordo P that whatever. Just find me. Just follow Dave Nadig, and I'll be I'll slip into a stream, and then you can find me and tag me there.
I love it. Happy Friday, gents. That was a real pleasure.
Thanks for joining us.
so much.
Thanks for having us.
Thanks for having me.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.